Ladies and gentlemen, our next session, Private Capital Outlook, Investing in AI-Fueled Risk-On Environment, will begin momentarily. Please take your seats. Ladies and gentlemen, our next session, Private Capital Outlook, Investing in AI-Fueled Risk-On Environment, will begin momentarily. Please take your seats. Ladies and gentlemen, our next session, Private Capital Outlook, Investing in AI-Fueled Risk-On Environment, will begin momentarily. Please take your seats. Ladies and gentlemen, please welcome to the stage Jamie Montgomery.
Hey, is that the best you can do? Jesus. All right, there we go. Next year I'm gonna bring numbers, you can hold them up, but only have 8s, 9s, and 10s, from the Russian judge. Look, this is always a highlight for me, this next session. I think we all come here when we want to know where the world's going and how it's going to affect private capital. And as we thought about this, I remember being on stage here 20 years ago with Sandy Robertson, and we talked about the IPO market being, had a filter and eventually would open up. And we had a headline, and it was after the dot-com crash, and it was like 2004, and technology is back. And CNBC just thought we were nuts, but we thought about the next 4 years, what that great boom was. We've just gone through think about the last 5 years. We were here 5 years ago, the start of COVID, and then we had the largest tech correction ever, and then a AI boom, and then we have a lot of happiness around a new administration, and then a lot of volatility around the last couple of weeks. And so I don't think there's a more pressing issue for all of us who are investors or building companies in the innovation economy, which is how we should look at capital. So when we put this together, I wanted to find 3 very distinguished people. And Matt, who has a real good call on early stage venture and helping the companies expand. George, who's done some of the larger transactions in the country and later stage and has a big success announced late last night. And Monica, who even has a broader view in her role. So Tony, why don't we introduce the other 3 panelists and welcome to the stage. So Matt McElwain, George, and Monica, come on up.
Please welcome our panelists, George Matthew, Matt McElwain, and Monica Adrakis.
All right. Thanks for being here, George. Welcome. Well, we had our org call a week or so ago, 10 days ago, and everything's changed. And I mean, it's unbelievable. Everything all at once, like that movie title from a couple of years ago. Jeez. And I was watching the replay of the State of the Union last night, and it's, it's really interesting. The new admin settled into office. It felt like it was a risk-on environment, growth over profitability. Bond prices were a question mark. They seemed cheap relative to equities, but then that would always correct. And what does it mean for the private capital markets and how things should be priced? And is there real disparity between pricing of the quality companies? Is everything priced to perfection? How do you finance growth if you're an entrepreneur? And when to finance? Is it now or do you wait? Is there a bubble? Has the bubble burst? How to navigate it? Those are the questions that many of you have. And we're going to do our best to try and address those questions today. So I don't know, I asked each of the 3, Matt, Monica, and George, to kind of prepare some opening thoughts to share, and then we'll do some Q&A and discussions and get into it. Matt, you want to go first?
Well, sure. So Madrona sits as an early stage venture capital firm based in Seattle, and we make investments from day one for the long run in our companies. We wrote a piece in January, and we're going to stick by that piece, notwithstanding the volatility, which is that we are in a risk-on environment, that we are in an environment that's relatively stable from a macro perspective. Of course, the adventures in the last several weeks here on tariffs and some of the international policy issues are a little bit high volatility, destabilizing. But in general, from an inflation perspective, from an interest rate perspective, from an unemployment perspective, we could go down the list relatively stable. Secondly, there's a lot of companies that got their acts together over the last 3 years, public and private. After raising tons of capital, being in a ZERP environment, you had quite a bit of discipline on balancing growth and cash generation. I mean, just take Amazon as an example. Amazon burned $20 billion in 2022. $20 billion of negative free cash flow. In 2023, they produced almost $35 billion of positive free cash flow. That's a pretty big transformation. So a lot of companies have gotten their operating house in order and are understanding the drivers of that. And then you get the capital markets side. And the reason we think that's a big risk-on environment, you saw the transaction yesterday, weights and biases, there's a lot of people on the buy side that have capital to put to work. Private equity, $1 trillion plus sitting on the sideline. But now the strategics are coming back in who were largely off the table for the last couple of years, largely because of what was going on with the DOJ and the FTC. And in fact, more of the acquisitions this year have already been on the strategic side versus the sponsor side. And then on the sell side, you've got a lot of people in the venture business, I'm sure we'll unpack this, that have reasons to sell their companies, and a lot of companies that have gotten their house in order, and so there might be a tighter spread between the bid and the ask.
Yeah.
And so we think that's all set up for risk on.
George, you want to go next?
Sure.
Turn over to Monica.
Yeah, we have a little bit of perspective now going on our 30th year as investors in software, and I think should be just generationally that long in software, with Fund 13 for Insight Partners being a $12.5 billion Fund 13 that we just finished raising and now deploying at scale. We see every end of the spectrum, including when the Databricks deal was done more recently. My first presentation at IC was the Databricks deal, and the last presentation that same IC was a seed investment that we made in a New York-based company that was doing observability for LLMs and agents. And the reason I just mentioned that is the reality of what we're seeing in private capital at scale is the opportunities to what Matt indicated are very much there. And what we search for is just generational founders and opportunities where growth will occur in spite of everything that's happening in the market. And certainly yesterday's announcement with weights and biases was one of those generational moments. And we just think that there's more opportunities now in data, AI, ML. It's something that I'd been focused on as a builder for many years, and now in the last 4.5 years as an investor, and we're just getting started.
Well, it's nice to have you here, George. I remember 22 years ago sitting here with one of your co-founders of Insight, so it's a whole generation ago in some ways. But, Monica, you want to share your perspectives?
Yeah, thanks, Jamie. Thanks for having us, first of all.
You're welcome.
A fantastic event, as always.
Nice to have you here.
And thank you for asking so many simple questions to kick us off. I'm sure we'll have all the answers. So I'm Monica. I'm with CPP Investments. By way of background, we manage about 700 billion Canadian on behalf of 21 million contributors in Canada. We operate as an independent Crown corporation, so we have one mandate, which is to maximize returns. Obviously, with that scale of capital, we invest across a lot of different things. We are a global investor with 10 offices around the world, and given who our beneficiaries are, we tend to think in a very long-term horizon. I think one thing that's really interesting, we've got AI fueled in the title of this panel. I think one thing that's been very interesting for us with the AI backdrop is just how multi-asset class AI really is, and how much opportunity there really is across different asset classes that's being fueled by AI at the moment. So, at one end of the stack, you've got a need for real estate, data centers. I mean, we're making very active investments there. We did a recent took an ownership stake, with data centers in Asia Pacific. We're doing it around the world, which is an interesting dynamic as well. You've got energy implications of AI. I think we all know that AI compute's going to require more and increasing amounts of energy over time. And so, our sustainable energies group, which invests across renewables and traditional energy, as well as disruptive technologies, are paying very close attention to, AI and what's needed there. Our private credit group, they made an investment in CoreWeave on the private credit side. And then, of course, there's my world. I lead growth and venture investing, all around models and applications. But I think what's been really interesting for us to see is how all these different aspects come together in the way that AI is going to move us forward. And obviously, these different asset classes have very different risk-return profiles and time horizons, which we're excited about the diversification that sits behind that.
Thank you, Monica. One of the things that struck me in some of our conversations is the time frame upon which CPPIB, what was it, 70 years, or what's the investment perspective?
I think, so we are long-term by nature.
Yeah.
However, I think we're also diversified across time frame, depending on the asset class. So, at one end of the spectrum, you might think about real assets as having a multi-decade time frame. On the other hand, venture growth is probably the other end of the spectrum.
You hope it's shorter than that.
You hope it's shorter than that. And you hope that, one, the alpha or the return profile sort of, compensates for some of that time horizon. I think we also take a view that a lot of the investments we're making in venture and growth, that's the tip of the spear. But those companies, the winning companies, are going to be legendary companies for a long time. Yeah. And we would certainly love to continue to invest in those companies through public markets and through their life cycle. So in a way, those are also very long term.
Yeah. No, it's terrific. It's Matt. I mean, we talked about a risk-on environment, but when you have risk to the NATO, North Atlantic Treaty Organization, and the security posture of the West, you have, looks like inflation's harder to tame. You probably have negative economic growth in Q4 and Q1. When does a risk-on environment kind of rethink it a little bit? Is there a 10% correction in NASDAQ since the start of the year? I mean, what factors and variables in there that might cause us to rethink risk on versus risk off? And then, play that out. You think about the IPO market. Maybe there's 30 or 40 IPOs this year. Maybe next year there's 50 or 60. But, when you think about it, is it just the volatility, or is it the risk itself? Or?
Yeah, look, I mean, the macro is important for us to understand because it's the things you can't control. Yeah. And so you've got to be cognizant of it so that you can incorporate it into your strategy. How much forward-leaning as an early-stage startup are you being in terms of the experiments you're running? Experiments could be product line extensions. Experiments could be, incremental hiring on your go-to-market team. And so what's most important there, of course, is to have dialed-in product-market fit. Yeah. And so I think you got to be cognizant of the macro on that front. I think it's more important on the capital market side, as you say. Yeah. So, I think this year's gotten off to a little bit of a slower start in IPOs than people anticipate, but I think you'll see more of that open up. But we've heard from different, banker friends about how many companies are on file. I think the M&A market, because the strategics are back in the game, that puts pressure on the sponsor buyers. And then you've also got, we just raised our 10th fund, which is a little more modest than George's. It's a $770 million fund, and congrats to Insight. But in raising that, there's a lot of DPI pressure, or distributions to paid-in pressure. Happily, we had a very strong year last year, and the fundraising went smoothly. But because of that DPI pressure, you are going to see more of the holders of these shares in these companies be willing to sell. And ironically, the other side of that coin, you've got literally hundreds of billions of dollars of cash just sitting on the balance sheets of the 6 largest tech companies in the world. The Amazons, Microsofts up in Seattle, the others down in the Bay. And you've got this $1 trillion of PE, and a lot of that PE capital was raised in the 2020, 2021 timeframe. So you basically got a 5-year clock to put that to work in terms of initial investments. That clock's starting to run out.
Yeah.
So we think the setup's good there on the IPO and M&A side, even if some of the macro gets a little volatile.
So look at the capital flows, is what you're saying. George, you talked a little bit about data infrastructure. So where are you seeing the most potential now, and valuations perhaps sustainable through a period of bit of turbulence?
So I think there's a bit of a shift, particularly when we think about some of the AI investments that we've been making as well. It was very clear that a lot of the focus was, up to this moment, on the infrastructure that's related to, no surprise, the GPUs themselves, but also the foundation models, the things that were the tooling that would require to basically build the next generation of AI systems at scale. Weights and biases certainly fell into the tooling layer quite nicely. But we've been very careful about a lot of application investments up to this point, because we just felt like the platform needed to sediment a little bit more before going into large-scale application investments, particularly in around AI ML workloads. And now I'm of that mindset that the opportunity to go into applications is right, and the moment is here. It feels very similar to what the mobile wave looked like circa 2010, 2011. I always think about, like, what was the most popular search engine in 1997, right? In the first internet wave, it turned out it was Alta Vista, because Google wasn't there yet, right? And so I think we're kind of at that moment around AI, where the infrastructure, the sedimentation of what you're building as far as platforms and tools are there, and now you can start to build this next generation of applications at scale, and that excites us quite a bit.
All right. Okay, thanks. Monica, you commented you invest more broadly than tech, obviously, and upstream or downstream, however you think about it. But how is AI affecting your more traditional areas of investing? I mean,
well, maybe just a first comment.
Sure.
So, for venture and for growth, I think we're also taking a hard look at applications. And, our model is a little different in that we put about half of our dollars in with great GPs, such as Insight. And that, I think, has given us, we haven't made too many investments on the application side over the past few years. Like, we're in some late stage companies like Databricks and Scale AI. But earlier than that, I think we've really leaned on our GPs to get almost an index view of, what we think are probably some of the best emerging AI investments. And our view is that now some of those applications, to your point, are just starting to get to, their true growth phase, where you're starting to see some real revenue, and those are starting to become real material businesses. And so, we're a little, cautious about some of the valuations that we're seeing. Happy to talk more about that, but also I think excited that some of these are now starting to emerge as real businesses.
Well, let's talk about the valuations then. Matt, I'll start with you and we go back. Everyone probably have a point of view on this, of where the best opportunity is, relative pricing. But Matt, current framework, you talked about Madrona usually comes in early. Seems like either you have to come in early or you got to pay up to come in later. What's your framework for looking at the early stage versus later stage? And I know you've spoken in the past about founder market fit. Do you want to kind of?
Well, I think that in order to have a chance at founder market fit and coming in really early, you got to have a point of view about the world. We talk about it in having prepared minds. And one of our first ML investments was the Amazon professor of machine learning, Carlos Gestrin, and his grad students 12 years ago. That was a clear founder market fit. They'd built an open source project. That project was getting traction. They thought there was an opportunity to build a company around it. That company, which came to be known as Turi, ended up getting bought by Apple. Probably almost everybody in the room is using Turi's kind of capabilities that were built into this device and the device you have in your pocket, and et cetera. So what does that look like? We really think about 4 questions when you think about founder market fit. There's the why, which is why does this problem exist? Why is this problem so hard? Why do the solutions today that exist to solve that problem basically suck? or they're completely inadequate. And there's this next piece, which is the why now. And of course, I think we'd all agree. I mean, we started the Intelligent Application Top 40 5 years ago, which was a list of the most promising 40 private companies in applied AI in the world. We believed strongly that the value capture is going to be at the application layer, not the core model layer. And even, OpenAI, of course, leads that. But the why now is, why can that problem that I'm obsessing about be solved better than it's ever been solved before? What are the technological changes, the societal changes? And then there's the why this. And by this, the why this is what am I going to build? What is the solution to that problem? And oftentimes we find that even the most amazing founders, and we'll get back to them in a second, even the most amazing founders, they're directionally correct and specifically not quite right when it's that early stage where you've got to be willing to get in early so you don't have to be paying an arm and a leg for the price of these deals. And it's not just the early in paying, it's the risk shift that's happened in the last 10 years, in favor of the entrepreneur, which is fine, but we're all taking more risk for what has been de-risked in the business at each stage in the life of the business. The last why is the most important, which is the why us. Why did a Carlos Gestrin and Yu-Chang Lo and that team believe they could go solve the problem with their understanding of the why now, and then the vision of where they had in the why this, the product they were going to build. So that's what we're really looking for, but you truly have to have a prepared mind and I think a point of view in order to be successful.
Okay, well, George, you started talking about infrastructure and the application layer. Where in the stack do you think the best opportunities or value might be presented?
Well, maybe before I go into where the value will be presented, it might be worthwhile just to comment on where some of the current, sort of valuations are.
Well, talk about your weights and biases.
Yeah.
There's some rationale there. Why did CoreWeave buy it?
I'll go to a few things, but maybe just weights and biases. It was a very straightforward conversation, right? Because and we entered weights and biases at approximately 200 million in valuation, right, in 2020. And it was very early in the journey. That was just a bit of revenue. I think it was like literally 2 million in revenue. But what was really exciting at that moment for weights and biases was we started to notice that machine learning practitioners needed good tools.
Right.
And they needed those tools to do the experiment tracking and the parameter tuning and the version controls that were necessary to build this next generation of models. And it turned out that for weights and biases, OpenAI, Anthropic, Cohere, everyone but Meta, NVIDIA, Mistral, everyone but basically Google was using weights and biases for the de facto tooling for building their machine learning models at scale, the transformers that came to market. And by the time weights and biases kind of reached its peak, in the last call it a few months, we had 900,000 machine learning practitioners standardized on the product, right? I mean, it's a generational product and team at that point. So no one was looking for anything but further growth and continuing to build an incredible company.
Yeah.
And in the case of CoreWeave, they have been certainly doing some incredible things as a hyperscaler for GPUs, and they had to think about what the rest of the journey looks like.
Yeah.
And
it makes a lot of sense for
that's
CoreWeave.
how they found us.
Yeah,
Right?
It makes a lot of sense for CoreWeave. Gives them a lot of differentiation running up to the IPO. So where do you think, you have a point of view on the opportunity set throughout the stack, or is there anything else you want to share?
Yeah, it's a really challenging moment right now, right? Because you can certainly see some of the earlier investments. So I did an investment in a company that was building a multi-agentic orchestration experience called Crew AI. And it has literally taken off like wildfire in the market in the last year or so. We came in sub 100 million on the valuation. I sleep well at night on that, right? the end of the spectrum, we co-led, Thrive led the deal in Databricks, right? And we put about $1 billion into the last round at Databricks. And it was done at a $62.5 billion valuation. But Databricks is now I can talk about this because it's still a private company. It's 2.8 million going to 4.3 billion, right? And so that level of scale in a company that is executing incredibly well with a founder and a team that's surrounding them, again, you can sleep well at night. right? On the other end of the spectrum. The things that make me nervous are the research teams that are now raising at $5 billion for putting a new foundation model together. I won't pick on anyone right now.
We have one of those.
And then going back and then raising another round at $30 billion.
Yeah.
I'm like, wait a minute, like we're going to pay $30 billion for a research shop that hasn't shipped a foundation model yet, and Databricks is at 60. So I think that's the piece that makes most of us a little bit more nervous. So there are great companies that you can find, particularly in both ends of the spectrum, but I think there's also just a lot of frothiness as well.
Yeah. Monica, your perspectives you want to share on valuations and the market?
Well, I mean, just on that one, I mean, a question I think we're always asking ourselves, and you know, we certainly have partners who would advocate for this, is it's whether you believe that, you know, the future is going to accrue to winners. I think, you know, if you believe that Databricks, you know, still has a 5x upside from here, that's a $300 billion company, but $300 billion compared to the valuations of the Mag 7 right now, you know, feels kind of believable.
Yeah.
Or even the $30 billion company that you're talking about, okay, they don't have a product or revenue, but you know, if they actually have the core elements to become that next $1 trillion company, you know, maybe you get comfortable with the underwrite. I think one of the things I struggle with on valuation right now, you know, a lot of the revenue multiples are just, you kind of have to squint. I guess there's a couple things I struggle with. I mean, one is the revenue growth that we've seen, the growth rate that we've seen sustainable? Because I think in a lot of these companies, it's incredible revenue growth. It's a growth rate, it's unprecedented, but it also hasn't been in place that long. And so, you know, can you just like with true conviction believe that that's going to continue is one. I think two for me is, you know, and maybe, you know, I'm speaking a little bit more of sort of early growth stage companies, but will they be competed away? And could they be competed away because there's another AI native startup that comes into the picture, or there's an incumbent that just, you know, has customers, has data, and figures out how to do AI? I think is a real question in some of these areas. And then finally, you know, I think so. I was an operator. I joined CPP a few years ago from Meta. I launched a business there. And one thing that I see consistently is I think investors underestimate execution risk. You know, ultimately, a lot of these AI native companies are going to have to build and execute at excellence on their go-to-market capabilities. And I don't know how they're all going to do that.
Yeah, I totally agree with Monica here.
They're not.
They're not. And I think it's like, what is the durability of that? You know, so that founder market fit, that why us team, and they can build a team around them and then build a scalable, durable business.
Yeah.
That is the hardest it's ever been in venture capital. And to give you a data point on that, so we do this intelligent application 40. We get all the venture community, George's team, a whole bunch of other venture firms contribute ideas and vote on it. Jamie's team does as well. And we come up with this list of the top 40 private companies. Now, mind you, there's been basically no IPO, so none of these folks graduated out by going public over the last 40 years. There are exactly 4 companies that have been on the list all 4 years. 4 companies: Databricks, Hugging Face, Abnormal, and Runway. And there's been like half of the thing turns over every year. So now you're venture investors like us, and you're trying to sit there like, what's the durability? What's the scalability of the companies I'm backing? How do I think about that? How do I assess it? Even if, as is also true, you're having companies right now that are just growing like crazy. You know, 5, 10, 25, $40 million revenue growth in 1 to 2 year periods of time, and in some cases accelerating. What's the durability of that?
Yeah.
Okay, well, that leads to another question. Thank you for that. I just thought you wanted different companies each year. I'll just send you the same names every year. Make a note of that, please. We can be very consistent. Yeah. You're talking about go-to-market execution. It's a challenge, right? How many companies scale? But we're also seeing companies scale quicker than ever, more speed. and more velocity, will we also see capital efficiency, or are they just burning more money? Anyone have a point of view on that?
It depends.
It depends. All right.
Here's why it depends, right? So I don't know of any foundation model company that's capital efficient right now.
Yeah, but,
right?
but the applications are being built on top of other
And
things.
so let's talk about
Like
that,
Cursor,
right?
or Lean,
and those companies are getting pretty efficient, right? Cursor's growth is phenomenal, and they're doing it with what, 40 people, right?
Yeah.
So that's a very efficient version.
We're seeing companies go from 0 to 100 million in a year, right? That's what we're talking about.
40 people.
Yeah. Sorry, 40?
40 people.
Yeah.
At Cursor right now.
Yeah. And you say,
I've got another example here, right?
All right, go ahead.
So we invested in a company called Relevance AI, and they started to build fully digital workers. Like, you can build synthetic workers that can now go and become BDRs, SDRs, and complement the human workforce.
Right.
About a year ago, that never existed. Like, you couldn't even think of like that as a possible idea. They actually price based on a percentage of what you would pay an SDR, BDR as they kind of price and come to market. It's a team of like now 20, 30 people. They've grown 5x this past year, and they're growing again with an NPS score of 71. Customers are incredibly happy to use the product. So it's taking off, and it's doing it, with an incredible amount of efficiency. Like, we're not burning much to do it. So there are definitely companies, and I think Monica's point is right. Like, you got to think about like, okay, is that going to be sustainable? Some of those answers you generally don't know, right? Like, right now it's like, okay, Relevance seems like it's going to be fine, but we don't know if people are going to keep buying synthetic workers to do
let me
this
ask
work.
Monica, would you ever back a synthetic venture capitalist?
No.
Why would you do that? Please.
I'm just curious. I got to have something to look forward to.
Well, the term of art that you'll hear a lot more, I think, in the coming months is this notion of the small team meme. That these small teams, like the one that George is sharing, in our portfolio, you can think about companies like Read.ai or StatSig that are just growing tens and tens of millions of dollars a year with very small teams.
Yeah.
And it's a little like, wow, how long can we do this? And can we create a sustainable distribution moat and not hire a lot more people? And I think the answer maybe can be, we do actually need to hire some more people to create a sustainable distribution moat, but what's the limit of that?
Yeah. And what's the revenue per head or revenue? Yeah.
I would still take that risk in a venture bet every day.
Yeah.
It's worth it versus putting the last check into, the foundation model that's raising at 60 billion.
Yeah. All right. We talked about fundraising. Monica, you're here. 2 massive funds raised, CPP, IB, large source of capital. Where's the liquidity coming from now into the funds relative to 5 or 10 years ago? Matt, how has it changed, fundraising?
Do you want to start?
Or Monica can start, or
Go ahead.
George. It's all going to come from Greenland, we know.
Gosh, yeah.
The sovereign wealth fund of our 51st state.
Exactly.
And how do you feel about Canada being the 52nd state? All right, we want to have a sovereign wealth fund in America. It's going to be cheaper to buy than build, right?
What I've heard is it's going to look quite different. Where is the liquidity coming from? Well, I think embedded in your question is the assumption that there is a lot of liquidity.
Well,
which,
synthetic liquidity. Yeah.
I think one of the things that's been quite surprising, obviously the IPO markets have been slow the last few years.
Yeah.
Historically, 70% of venture exits were to the public markets. And so, and at the same time, M&A sponsor sales have also been slow as interest rates have risen, right? Buying anything has become much more expensive. And so liquidity is, by and large, kind of dried up, been very slow the last few years. And so I would have, if we were sitting up here a couple of years ago, I would have predicted that things that like capital availability would have really slowed down. And I think, if anything, the opposite has happened. Like there doesn't seem to be any lack of capital for good opportunities up and down the stack for great GPs, et cetera. And I think there's probably two reasons for that. I think one is there's a lot of interest in what's happening in the world of AI in particular globally. And so I think there's a lot of international capital coming into the market in a way that we've never seen before, one. I think two is, investors who have put capital into the market historically, yes, they're experiencing illiquidity, but they're willing to stomach it because they believe so much in the opportunity. And what that probably means, bit of a conjecture on my part, but what that probably means is that they're reallocating capital from other places. And in their own allocation models, and being okay with the illiquidity that that's bringing, anticipating more of an illiquidity premium going forward.
So two things to add here. One on this, kind of the LPs investing into funds like ours. So the stats for last year was there was about $70 billion raised by venture funds. What's interesting about that $70 billion is that the top 15, so we would have been the 15th of those top 15 in our $770 million fund, raised 60% of the capital. The remaining almost 420 funds raised the rest, of course, and the bottom 90% of those raised 28% of the capital. So you got over here, on average, the top 15, north of $1 billion funds, and over here you've got sub $50 million funds on average. And so you have this very different dynamic. And then George comes in, I think that would have been the biggest fund of the year last year in what Insight's done. And so you see this very much have and have nots. We of course like to say we're kind of the best of both worlds. We're big enough to take you through the whole journey from day one for the long run. And we're also small enough that we're actually going to be able to roll up our sleeves and add a ton of value. Be that as it may, those are some really interesting stats on the dispersion of the LP GP relationship.
True. So March, Madrona, the M's are right in the middle.
Yeah, the M's are good, right in the middle there. Yeah.
All right. So, but what about your LP composition? How has that changed?
Ours has actually not changed that much. We've got a number of university endowments. They're fantastic partners, longtime partners. From the Harvards to Carnegie Mellons to UW and Berkeley on the West Coast. We've got some, you might guess in Seattle, the kinds of family offices of folks from the Amazons, Microsoft, Macaws of the world. We've got some outstanding, fund of funds in different forms and different formulations. The top tier capitals, the investment fund for foundations, those kinds of folks that we've been working with for years too. So a lot of continuity there. We added a couple new relationships. We try to do that every fund cycle. And the biggest two challenges we saw, and it'd be interesting to see what you, because you both sit in different seats here. There was a lot of push on, hey, DPI. Happily, we'd had a good year, but there's a lot of pressure on DPI, especially on the endowment side. And then there was a lot of skepticism on valuations. And
how you're holding them.
We definitely got more of a proctology exam on that in Q4 last year than we typically do in our fundraising cycles. A lot of like, okay, tell me. And I kind of was like a little bit like, is that even the right question? The question I think you might want to be asking is, what are you doing to help your companies build value versus what's their current value? And how confident are you in the teams? And what's the evidence of that confidence that they actually can scale and build the business over time? And so we're going to be talking a lot more about that at our annual meeting in a couple of weeks. But that's, I think, the real focus versus a point-in-time valuation that's admittedly been a volatile set of market dynamics.
We're very similar boat, I think, on that. One thing I would say is we found, and Monica, you touched on it, is international interests, sovereign wealth funds, particularly in the Gulf. We also found RIAs and platforms, and global RIAs. Endowments are kind of over their skis, I think, and fund of funds as well. They're sort of shrinking, but these newer emerging players, and then families that maybe hadn't traditionally had access, who are reallocating because they want access to AI. So it's been interesting. Well, I think there's a couple of questions. We have about 8 minutes left here, and I think we should talk a little bit about liquidity. Monica touched on it, the IPO market, historical lows in 22, 23, 24. George, what's, in some ways, Databricks is a surrogate IPO because it provided some liquidity, or a lot of liquidity.
Unquestionably, it was a private IPO.
Yeah, it was a private IPO. Yeah, maybe talk a little bit about it, and what's kind of the insight perspective on the IPO market?
We're pretty
the insight.
We are very excited for where things are coming in 2025. There's a number of insight companies that are starting to set themselves up. So that's certainly not something that we've been able to talk about for a few years now. So it feels good that the IPO markets are opening up. Certainly, S1 and CoreWeave yesterday, or what was it, Monday, is an interesting starting point. We'll see how the markets continue to fare for an asset like that. But yeah, we think this is going to be a good year. And I think as we talked about in the panel, it's not going to be a watershed year, right? Just because the engine is just getting activated again after being dormant for, it feels like a good 2 to 3 years. So we're looking forward to it, and there are some really high quality names that will go out. I think the difference that I look back at this, and so I was president and CEO of Alteryx when I wrote the S1 and took Alteryx public in 2017. I mean, we were like under 100 million. That was, even for those days, it was pretty subscale, and we grew in the public markets all the way to $1 billion in ARR. There's no IPOs for companies that are in that range, and that's been far gone.
So minimum,
the minimum threshold now feels like it's 400 or 500 million minimum, and that's I feel like there's a lot of growth that investors miss in the earlier journeys, but it doesn't seem like there's an appetite for that earlier growth, the 100 to 500 million in public markets. And so we are where we're at.
What's driving that? It's just there isn't the LP interests in, the public market interests in something less than $3 or $4 billion in market cap. The float isn't there, and the buyers aren't there. What
I mean, it's got to be some of those things. I kind of think about this a little bit now. It's like if you're an exchange outside of the U.S., right? Like I can see now companies that are coming out of India really build scale in North American markets and then go public back in India. Like that seems like a playbook. I'm surprised there hasn't been more of that.
Until you distribute Indian shares to your LPs and they wonder what the hell is going on. Or you try and get money out of it.
But I think there are other markets beyond the U.S. that you can be considering when you're sub 400 or 500.
Yeah, Australia, UK.
Right. Exactly.
Gulf, Dubai. I don't know. It's always these point-of-time observations. I feel like if you're 250 million and you're growing at 40%, I think the market will give you a way out next year.
One would hope. But the flip side of it is, look, there's enough private capital to take care of those. If you're a Rule of 40 or like a 40% grower that's near, call it profitability, if not, there's no reason why there wouldn't be like massive amounts of private capital to be able to support your journey.
I think just to layer onto that, I think that's the part of the equation, is a lot of things are easier to get done when you're private.
Yeah,
you don't
acquisitions.
You don't have the same level of scrutiny.
Yeah, scrutiny.
And as we talked about, there is a lot of availability of private capital, and I think even this phenomena that you described, with Databricks, which is also true of Stripe and like many other late stage companies, I think it's here to stay. Because the capital is there, and again, the ability to continue to invest in your company, to maybe show less operating efficiency than you'd want at the expense of growth. Like in some ways, you get more flexibility. Don't get me wrong; I think becoming a public company is good for all sorts of reasons.
Yeah.
But from a flexibility standpoint, there's some merit to staying private.
Yeah, I think there was this issue of a lot of these companies were growth at any cost up through 2021 and into early 2022. And then there was this whole get fit era. And so now you basically got 0 tech companies growing more than 30% as public companies. And so people are like, wow, I'm going to need some scale to get to generally speaking, to the efficiencies of if I'm not growing more than 30%, I got to be at least 10% free cash flow operating margins to be in the rule of 40.
So you got to be a certain scale to
And
get
so,
to that.
we are seeing in certain categories, let's take one, kind of the whole sort of sales enablement, sales automation category. There's 5 or 6 companies in the $100 to $300 million private companies in that ballpark right now.
We have one of them.
And so there's lots of questions, right? Should a couple of those get together, build the scale, both top line and bottom line, so that they would be a more attractive to the public investors, as an IPO candidate. And I think that's the kind of thing in a risk-on environment. You're going to see more people willing to lean into those kind of possibilities this year.
But the market's really pretty efficient, though. I mean, you think about 2021, interest rates were 0. A lot of crap went public. A lot of them were structured, deals, SPACs. But you look at 23 and 24, the IPO performance was 74%, 1 year 76%. So the IPOs performed well, right? I mean, so at the end of the day, if the IPOs on average are going up 74%, there's going to be a market for buying IPOs, right? I mean, I think people kind of overthink this a little bit, and so I feel like it's, I probably took 40 or 50 companies public. I just feel like it will probably come back in 26, 27, but I think there's longer term private capital alternative, because some of these companies, if you have a $200 million company, you can have a lot of volatility quarter to quarter still, right? It's lumpiness. There's all these acrobatic efforts at the end of each quarter to, diving save of some deal to get a signature from because somebody, has the flu that day and can't sign it. I mean, it's just unbelievable. Like if you got a cloud software company, like 85% of your bookings can be the last 2 weeks of the quarter, right? You remember this, right? It's insane, So if you're living by the sword, you die by the sword, right? So I think you want to get to a certain scale where you have enough ability to absorb that volatility. So let's kind of close. What will our investment narrative be 12 months from now? Monica, you want to try that, or?
You got to start with me on that one, huh?
Is that proud?
I think
American Sovereign Wealth Fund. Yeah.
I don't.
Don't worry, we'll have a moose on the logo. Trump likes moose, from what I understand.
12 months doesn't feel that far away.
No, it doesn't.
So I think many of the things we're talking about will probably still be topics of conversation. On the other hand, I think the rate at which AI is moving, the way in which the U.S. administration is moving, the velocity at which the U.S. administration is moving, I'm hopeful that we'll have a little bit more clarity on a number of the questions that we've raised today, like the sustainability of, growth rates, like some of the macroeconomic factors right now that I think are very much in limbo. So I think in 12 months, I don't know that it'll be dramatically different, but I'm optimistic that we'll have a bit more clarity than we do.
Okay. George, I'll give you a 13.
I'm going to go back to exactly what I started with. We're going to be very focused on finding growth, and where the growth can be had in particularly early stage, and things that are a little bit more discernible and understandable, particularly in the late stages. We're happy to do that. And as long as, I think Matt indicated this, like going in with a prepared mind, having a bit of humility to say you don't have all the answers, but you can find incredible founders and incredible folks that you can build generational companies with. That's where Insight's going to be.
George, one of the things I'm seeing is some of the early plays, like we're in Excel data together, right?
We are,
yes. Yeah, and it was, it's growing, it's doing all right. But all of a sudden, with agentic AI, they realize they're in a position where their TAM is, 5x bigger than it was before in the data observability. So in some ways, these tech trends can take some existing companies and really, increase their velocity. And I think, it's kind of interesting. I look at that, and the next couple of years could be super exciting there.
It was probably I can say this among friends, probably the most dynamic board meeting we've had at Excel
Yeah.
Data because of this agentic opportunity. That's
Ever since we intervened, things have really looked up.
pretty excited for what Rohit and team.
All right, Matt, how about you?
I think
14 months.
One extra thought on this,
All right.
which is I think we're going to be talking a lot more in the AI world a year from now about the winners and the losers, and increasingly the gen native companies are going to be emerging as winners.
Yeah.
And we've had a lot of great long-time companies, the ServiceNows and Salesforces, are talking a big game and agentic and stuff. They'll probably all still be doing fine, but we're going to see more of these companies that are able to be durable and emerge as the winners and apply.
So they'll be the winner. They'll be the ServiceNows of the Gen AI of the
Next gen.
And what would be the early signs of that? Early kind of.
Well, I think some of this breakout revenue growth, but also understanding how am I solving a problem differently? Because largely companies, I mean, McDermott's trying to do a lot at ServiceNow to change this, but largely companies built very structured workflows with very structured data flows to solve a specific problem.
Yeah.
We think it's going to be multi-structured, so unstructured data, semi-structured data across multiple workflows, or what I like to think of as cross flows, where you can go solve a problem, win a market, and then it's going to be the groups that are starting to be invited into the adjacencies to the first problem they solved. And that's how they're going to build on the success of these first tens of millions.
One example that Matt just indicated, I'm totally vibing on this. When you think about the companies that are large incumbents that have built co-pilots to this point, that is not fundamentally changing.
No.
It's literally like sprinkling AI pixie dust on your existing
Or lipstick on a pig.
Yeah. But like what Matt indicated now, it's like we're seeing this first generation of like autonomous, I would almost say, agent-based autopilots. Like literally, these are not co-pilots anymore. Like the autopilot's emerging now and the next year.
And that's your user interface.
That's something that we're very excited by.
Yeah, if it's easy to use and actually works, I think that goes a long way. Hey, common sense, add that to the list of a prepared mind. I think Charlie's list for me was always surround yourself with decent people. Everyone, it's a great group here. Be open to lifelong learning. I think we're all participating in that today. Have uncommon common sense, and prepared mind. So wish you all the best in the coming year. Look forward to having you back to see where we're at in the coming years. Thank you very much.
Thank you.
Thank you, audience. All right, thanks, Matt.
Thank you.
Thank you.